Picture a world of untapped potential, where the underdogs rise to the occasion and yield impressive growth. Welcome to the realm of small-cap stocks. In the bustling marketplace of stocks and shares, there exists a group of companies often overlooked, the small-cap stocks. These are businesses with a market capitalization of less than $2 billion. They may not have the grandeur of their larger counterparts, but they have a charm of their own. Imagine walking into a forest, where giant trees tower above, grabbing all the sunlight. Beneath these towering giants, you find smaller saplings, striving to grow, full of untapped potential. These saplings are akin to small-cap stocks, striving to grow amidst the towering large-cap stocks. Small-cap stocks are like hidden gems in a treasure chest of the stock market. They often go unnoticed, shadowed by the larger, more popular stocks, much like the saplings beneath the towering trees. But it's these very stocks that often carry the potential for high growth, offering investors an opportunity to reap substantial gains. One of the most interesting aspects of small-cap stocks is their relative obscurity. They're not typically covered by the big analysts, not making the headlines on financial news networks. This lack of coverage is not a reflection of their potential, but rather a testament to their under-discovered status. Investing in small-cap stocks is like betting on the underdog, a thrilling experience for those with an appetite for risk and reward. These stocks can offer a high return on investment, but they require a keen eye, patience, and a willingness to explore the road less traveled. In the world of investing, it's not always the size that matters, but the potential for growth. And small-cap stocks, with their dynamism and resilience, often hold a wealth of opportunities for those willing to delve a bit deeper into the world of stock investments. Now that we've set the stage, it's time to delve deeper into the world of small-cap stocks. Small-cap stocks may be small in size, but they pack a mighty punch when it comes to performance. Let's delve into some recent performance data for small-cap stocks that illustrate their impressive growth rates. One example that stands out is the S&P Small Cap 600 Index. This index showcases a total return of 23.6% for the first half of the year. Quite a feat, isn't it? But it doesn't stop there. Small-cap growth stocks have seen a whopping 16.5% increase in the same period, while small-cap value stocks have surged by an even more impressive 30.6%. These figures are a testament to the potential of small-cap stocks. We also need to discuss AAI's O'Shaughnessy small-cap growth and value stock picking approach. This approach, focusing on small-cap stocks with upward price momentum and seeking cheap stocks on the mend, has gained an extraordinary 164.3% year-to-date. Historically, small-cap stocks have outperformed the overall market due to limited analyst coverage and low correlation with larger-cap stocks. This trend seems to be continuing, as the numbers clearly showcase. But there's more to this success story. Small-cap stocks are also known for their attractive prices. Compared to large-cap stocks, small-cap stocks are often trading at more affordable prices, providing investors with an opportunity to diversify their portfolio without breaking the bank. So it's clear that small-cap stocks are not just about small size. They're about big performance. They're about the potential to grow. And they're about providing investors with an opportunity to invest in the future success stories of the business world. The numbers speak for themselves. Small-cap stocks are a force to be reckoned with. Entering the small-cap arena requires a solid game plan. Let's explore some strategies. Investing in small-cap stocks can certainly be a thrilling ride. With potential for significant returns, it's no surprise that many investors are drawn to this sector of the market. But to navigate this terrain effectively, one must be equipped with effective strategies. One such strategy is the O'Shaughnessy small-cap growth and value stock picking approach. This method focuses on small-cap stocks that demonstrate upward price momentum and are considered cheap stocks on the mend. But what does this really mean? Let's break it down. Firstly, this strategy targets stocks with a market capitalization between $200 million and $2 billion. Market capitalization is the total value of a company's outstanding shares of stock. It provides a snapshot of a company's size and growth potential. Secondly, The O'Shaughnessy approach looks at price-to-sales ratios of less than 1.5. This ratio is a measure of the value investors are willing to pay for each dollar of a company's sales. A lower ratio could indicate that the stock is undervalued. Thirdly, positive earnings per share growth is another crucial criterion. This means the company is increasing its ability to generate profit for each outstanding share of stock. Lastly, the strategy considers above-average 13 and 26-week relative strength compared to the S&P 500. This essentially measures a stock's performance in relation to the broader market. By applying these criteria, investors can identify promising small-cap stocks that may be poised for growth. It's like panning for gold, where the gold nuggets are undervalued companies with strong potential. But remember, even the best strategies are not foolproof. Always do your due diligence and be prepared for the inherent risks of investing in small-cap stocks. With the right strategy, the small-cap field can be a goldmine of opportunities. While the potential for growth is high, small-cap stocks come with their share of risks. This is a fact that's as certain as the rising sun. One of the most significant risks associated with investing in small-cap stocks is their higher volatility. These stocks can experience wider price swings, both up and down, compared to their large-cap counterparts, making them a bit of a rollercoaster ride for investors. This volatility can be attributed to a few factors. For one, small-cap companies often operate in emerging industries or niche markets. This means they can be heavily impacted by shifts in market conditions or consumer trends. For instance, a sudden change in regulatory policies or a shift in consumer preferences can heavily impact the business prospects of these companies. This, in turn, can cause drastic fluctuations in their stock prices. Another risk factor is their sensitivity to economic conditions. Let's take the Federal Reserve's plans to raise interest rates, for example. Higher interest rates can increase borrowing costs for companies, which can be particularly hard on small-cap companies that rely heavily on borrowed money to fund their growth. This can hamper their profitability, thereby affecting their stock prices. Additionally, small-cap companies often have less financial resources at their disposal. This can make them more vulnerable to financial setbacks, such as a poor earnings report or a downturn in the economy. Their limited resources can also mean they have less room to pivot or adapt when faced with challenges, which can further exacerbate the impact on their stock prices. Lastly, small-cap stocks often have less analyst coverage, meaning there's less information available to investors. This lack of information can make it more difficult to make informed decisions about these stocks, adding another layer of risk to the investment. But remember, with higher risk can come higher reward. The key is to understand these risks and consider how they align with your investment goals and risk tolerance. Understanding the risks is a crucial part of navigating the small-cap market. To bring it all home, let's shine the spotlight on a few small-cap stocks that are making waves. First up, we have CarParts.com, an online retailer specializing in auto parts, which is expected to benefit from the ongoing semiconductor shortage. Their unique positioning in the market and potential for growth make them a standout in the small-cap landscape. Next on our list is Dine Brands Global. They're the folks behind popular restaurant chains such as IHOP and Applebee's. Despite the challenges presented by inflation, they've shown resilience and a potential for growth that's hard to ignore. Last, but certainly not least, we have Guaranty Bancshares, a Texas-based commercial bank. While the banking industry may seem crowded, Guaranty Bancshares has carved out a space for itself and has shown consistent potential for growth, making it a promising small-cap stock to keep an eye on. Remember, these are not recommendations, but examples that highlight the potential that small-cap stocks can offer. They each hold unique qualities and growth potential that could make them valuable additions to a diversified portfolio. Of course, due diligence is always necessary when considering any investment. These are just a few examples of the potential that small-cap stocks hold. We've journeyed through the world of small-cap stocks, explored their potential, and faced their risks. We've seen that these stocks, with their market capitalization under $2 billion, can offer substantial long-term growth. They've proven their might with impressive performances, especially when guided by strategic investing approaches. Yet, like any investment, they come with risks, often higher due to their size. Despite this, companies such as Hanesbrands, Lyft, and CarParts.com, among others, show the promising future of small-cap stocks. Remember, the world of small-cap stocks is vast and full of potential. Subscribe to our channel for more insights, and join us as we continue to explore the fascinating world of finance.